Welcome, everybody. My name is Michael Como. I'm Director of Content for T3 Live, and I am bringing in David Prince today, as we do every week, because we need to know what the heck is going on with Netflix earnings. That is the big event of the week, and we need a game plan. So before we get started, let's quickly touch up on something we discussed last week. So, David, last week you told us the banks did not look great into earnings, and JP Morgan was a mess. The other ones are going sideways. So what happened to those banks?
Sure. A little bit mixed, but overall we've seen more downside than upside. And it was simply what we chatted about, which was they were priced for perfection. Without really superb reports, most have traded down. Notably, JP Morgan, which was trading 2.5 times book, has really been pummeled and is now down almost exactly 10% from recent highs. Bank of America didn't show up in terms of the numbers as well as most wanted, not trading very well. Citigroup, very solid number, but still was up 20% in a straight line, not good enough, down. The one that showed up and yet did give back half its gains yesterday was Goldman Sachs and Morgan Stanley, after just being beaten to a pulp off last week's news, kind of hanging in there, up slightly 3% today. But it's been a tough quarter where, there's been certainly more downside than upside. The banks were priced for perfection. And, when Jamie Dimon isn't guiding net interest income higher, it puts a problem on the whole banks. Goldman really stepped it up and is now, as I think a lot of people like to say, back to its core roots. And people are really excited about how well they're doing with investment banking, trading, that sort of thing. So they stick out as the winner thus
far. Okay. All right. So far in April, we're definitely seeing some weakness. The small caps are standout to the downside. Gold is basically the only thing that's in the green. And it does feel like, at least on social media, there's sort of like this markets in turmoil feel where everybody's calling for the end of the world. But how do you see things now as far as big picture environment goes?
Sure. If you're ready, I'm going to get really fancy on you. The average bull market looks like that. That's your 10% move down every year. You with me? This is where you say, yes, I'm with you. Okay, moving on.
We're all with you.
So, no, I'm teasing. So the most recent bull market has been like this. See those little dips? They're 2%. So the bottom line is it's been a glorious 4 months, right? With all but 2-3% dips. And this is all but the most normal pullback I've ever seen. But we really have been spoiled as to the market's performance, not only this year, but last year. And we're making a lot of nothing. We are, as of this morning, 3.5-4% max on most of the indices. A lot of them only 3.5%. And probably have some more to go, whether or not you want to say it's geopolitics or that we're starting earnings season, or the fact that yields are climbing back to highs, or the fact that the PE on the S&P is higher than it's been all but twice, and both those times was not a great time for the market. It's a really tough setup. So to me, I think people are getting a little emotional after getting spoiled, quite frankly. And then you add in a war, which God knows is utter chaos and really sad to see lives that will probably be lost. And I get the concern, but underneath, it's really not so bad.
Okay. All right. So let's get into this week's earnings. So it looks like this week, basically, there's three big names. We have ASML, which is a semi equipment company, Taiwan Semi. Both of those companies have lots of customers that are leaders like NVIDIA, Apple, AMD, so on, so on. And then we have Netflix on Thursday, which we will get to in a second. But let's start with the semiconductors, because they're up about 25% year to date, 60% off the October lows. Now, it does feel like there are some parallels, though not as extreme as with the banks. The banks were up a lot into earnings, and now they sold off. What do you see for the semis now that they're starting to come in?
I think it's going to be a tough quarter, and it's going to be case by case. Sorry to just make it that way, but it's really that simple. Like ASML traded amazing, and now it's plateaued and just been kind of flat, right? But it's still so far off lows. What were you? Well above 700. they're going to have to put up a big number, and more importantly, a really strong guy, right? Taiwan Semi, it's not expensive like a lot of other names, perhaps in many people's view, like one of the most important, if not the most important semi company. But again, it's not exactly like done poorly. And the stock was below 100. So both, although off highs, are, let's just say, tough prints. That said, they remind me a bit of Meta, which means even though they're tough prints, business is probably strong enough that they may impress enough to go higher. So neither strike me as a great short or great long, because if they're companies that can have big numbers, these would be the guys. Typically, they're not going to have outsized guidance the way you would see with an NVIDIA or even an AMD one day, but both have a lot of pressure, but at least are off highs. NVIDIA, I know we're way, we're a month away from earnings, but if that pulls back enough, or AMD recently got down 30%, those start to set up better, where they typically can raise guidance 10, 15, 20%, as we've seen with NVIDIA, sometimes 50%, and maybe those work. Anyway, these two this week, not quite down enough to get excited, but easier, definitely easier than the banks.
Okay, all right. So since we're on the topic of tech and semi, so Super Micro is not a semiconductor company, but it's basically tied in because they're AI.
It is as tied in as you get without being semi.
Yeah. Okay. So you have talked about the possibility. If you follow David on Twitter, you've seen this. He's talked about SMCI guiding up and possibly splitting the stock, because it's been exactly 3 months basically since they raised guidance the last time. So David, tell us a little bit about what you're thinking with SMCI here.
Sure. And I can really sound smart and be like, oh, they always pre-announce. But funny enough, someone was telling me how they're going to pre-announce. And I think I'm telling you the story because it proves we always learn. And I'm like, they've already done that so many times. If they keep pre-announcing, they look silly. And then someone told me, this is 4 weeks ago, David, they've done it every quarter for years. It's not like a new thing. I look back, I'm like, oh, thank you. They're dead right. So I learned something. And basically what we know is they very commonplace, up or down, great or bad quarter, pre-announce. And if you look back, I have this friend named Michael, as in you, who reminded me the last time they did was 118. Well, it's 416. And there's a very good chance they do pre-announce. Now, maybe they don't, but most of the street is aware they could very well do it this week. I think most importantly, it's still a fairly illiquid stock. It's not quite AMD or an NVIDIA. Let me take care of that sound. And there's a decent chance to actually split the stock as well. So if there is, let's just say, a guess, right, something potentially that might happen, this is my guess of the week, that they might pre-announce to the upside and split the stock. Do I have evidence to suggest they're definitely going to do it? No. We're reading tea leaves based on history, but there's a decent chance.
Okay, David, do you think there's sort of an odd kind of reverse psychology here? Because it seems like everybody's saying it's going to happen, so that means the stock won't respond. Do you think there's a chance the stock will actually respond positively?
So yes, but within reason, meaning you're dead right, right? When people are taken by surprise, you have much more likelihood of upside, right? Where when I'm already talking about it and I'm your average Joe, I get it. Some people think I'm not, but in all reality, if I'm talking about it and the next guy and analysts are talking about it, it takes some of the shock and awe out of it. So it's probably not up 150 points the way some people would like. Not only that, but there was that big debt offering they did, and you have those people always shorting against stock. So for a few reasons, I would not expect it up 200 the way I know some people have gotten accustomed to and are probably excited about. That's just probably not in the cards, because like you said, it's not going to be as shocking as when they've done it previously.
Okay, all right. Then that brings us to Netflix, because Netflix has been another big star. It's up 26% this year, 80% off the October lows. How do you see the setup for Netflix going into earnings?
Right through the middle, and I'm going to go with fundamentals, right? Which means I don't have a big edge. I'm just going to go based on history and what I'm seeing. Last quarter, I was pretty positive for two reasons. I really thought password sharing was helping their sub growth finally, and it did even more so than we thought, and that the ad platform was finally really starting to show positive returns, both much better than people thought, and the stock responded in kind. I kind of think that wasn't a one quarter thing. I really believe that the company probably is showing strong sub growth. So this is one of those where in the past I've been very aggressive on Google for earnings, or say an Amazon for earnings. I don't feel that way because the stock has really done quite well, but it trades at a decent enough valuation that if I'm right and fundamentals are still kicking in, meaning there's still growth to be had, because they were in a mature place. Without something changing in their business, they couldn't grow subs. And they finally found the two platforms, well, one platform, ad, and the other by cracking down on password sharing, they can finally grow. If they can do that again, I can see the stock be higher. There's also one thing, and it sounds silly, but it's worked for me. I remember being very bullish Amazon for a few reasons, and one of them being as simple as it was the only stock besides Netflix to be 20% off highs from 2021. And it became my biggest position a few months ago at like 140. No longer, obviously, but my point is Netflix is similar to that. It is now the last original FANG stock to still be 70, 80, well, actually over 100 points off highs near 750. So it has a few things going for it. I'm not super bullish, but I definitely would be a call buyer, not a put buyer. But I'm not in love with it. I'll probably take a shot. Bottom line, if I've had a good week into Thursday morning before they report Thursday night, I'll have some calls.
Okay, all right. So we talked about a number of leaders so far. Now let's talk about some of our uglier names. Tesla. So you talked about being a buyer near 144 to 145. Obviously, this has been one of the biggest disappointments in the market this year. Could you talk a little bit about the psychology of how people are viewing Tesla today versus, say, 3 or 4 years ago when Elon was God and this was the greatest stock to ever happen?
Sure. And I don't profess to be a Tesla expert. I just want to say there's some people out there who really follow it like tooth and nail, and they know everything. But I know enough. So Elon, like you said, could do no wrong. And the biggest problem they had is a wonderful problem, right? Production, keeping up with demand. That's really always been the case up till over the past year. So now you have questions regarding interest rates affecting them, demand waning, losing out in China to other major players. And you put that all together with them cutting 10% of their workforce. And as you put that tweet up, what I mentioned to people yesterday is like Meta was a huge home run for me because I thought, business is still pretty solid. And he's finally not, meaning Mark Zuckerberg is finally not wasting money on metaverse and the silly stuff. He's really going to show it in cash flow. It's an offensive move. So cutting staff, cutting the fat out of the business and really producing more cash flow, that was an offensive move. Same thing when Benioff did it at Salesforce, right? And then I said, Tesla is not the same. Tesla is doing it in a defensive manner. They're not going to be able to produce more cash flow. They're simply catching up to there being less demand. And that is why the stock's reacting negatively, because now people are coming to terms with, wait a second, rates aren't being cut. We need rates to get cut to maybe spur demand. They have problems in China. It's no longer can they produce enough product to meet demand. It is simply, is demand strong enough? I get it for the people that love Tesla. I'm not against it. The self-driving software and robo-taxis. But as rates remain higher for longer, people want to see some sort of valuation that makes sense, or at least a catalyst, right? Not a catalyst that's not going to hit in terms of numbers until 2030. So it is in a very bad spot. It's going to continue to probably have these cute oversold rallies, but it's not cheap enough for a value investor. A growth investor is going to look at it and say, where's the growth? So it's really not only a messy situation, it's a messy situation for both growth, for both value, for Chartis. It's messy.
Okay, let's talk a little bit about another sort of troubled stock. So Apple. So you caught a quick rally in Apple about looks like $7 or more over the 21 day. What was your thinking there, and what do you think of Apple from here? Because that's also being lumped in with Tesla as sort of a problem child.
My thinking was this. Sometimes, well, I try not be smart anymore. For years, I used to be smart. Apple's a mess. I don't like it. Its growth is slowing down. Its PE doesn't match its growth rate. It should be 150. And that's kind of saved me recently because stock continues to go low. And then it was Thursday or Friday. The stock is trading massive volume and gets above its 21 day for the first time in several weeks. I said, all right, put your smart cap over here. Be a trader for a moment. How powerful or important is this? And I looked, I'm reminding myself, and I said, you know what? It's kind of a big deal. A bunch of chart type people are going to get really excited. I got to own it. Now, how do I own this and not really worry about fundamentals? Got to buy enough size to make money quickly and not hang around because this is not a stock I want to swing. So I bought calls, I bought stock. It ran up 3-4 points rather than try and swing it and say this is the turn. I saw no reason why fundamentals were turning. I took 90%. I took all my calls off 177. I think it got to 178. I held like 10% of my stock. Once we got to 177, and then yesterday I saw 173, a little bit higher than where we started, and I said I'm done. But it was as classic a chart as I've seen that created a trade. But I also tried to not drink the Kool-Aid. I was like, this is a trade. Fundamentally, I still question whether I want to own this stock. So lucky enough, I sold most. Versus when I'm trading an NVIDIA where earnings are going up, I'm much more comfortable holding stock and not just trading.
Okay, so is your willingness to drink the Kool-Aid, or lack of willingness rather, is that just a function of the market environment we're in now?
No, I always say if I'm going to hang around in a stock, I don't care if charts break down. I'll sometimes my biggest money is in a chart that looks ugly because I have earnings as my backdrop, right? That becomes more important than the chart at some point. Look at what happened with Meta when he finally did the cost cutting. In the case of Apple, they don't have that, right? They have earnings deceleration, not growing. So when I look at something like an NVIDIA, I'm okay because, when I'm buying it when it's ugly like last week at 830, 840, earnings are going straight up. And that's my backdrop. Now, add in what's going on in the world, I'll take profits sooner, right? I did it today in AMD, which is something we bought yesterday. But earnings really give me there's charts, there's earnings, and actually they matter equally as much at different times in the market. So earnings give me patience.
Okay. All right. Let's get to some because David has to get going very soon. So we just have a few more questions. Since we talked a little bit, you said this is very orderly garden variety pullback. What do you think the odds are of a 10% pullback here, since we haven't had one in forever? Or is it
this quarter, right? I'm going to go. I shouldn't say this quarter. This next 4 weeks, as earnings come out, I think it's highly likely we have 8 to 9%. So another full amount that we've had now. Maybe not 10%, but we get 8, 9%. I'd say a 60, 70% odds.
Okay. Are there any names you like now from a swing perspective, or is it just short term for now?
I am 90% a trader for the first time in a couple of years. As I've been telling everyone, when we were, not now because I'm reacting, I said that at, on the Qs at 440, 445 just last week. And for a couple of moments, I looked like maybe I wasn't so smart, like maybe we were going to highs. And there's less to invest in. However, I always have a list. What are the names I want to invest in and at what level? So I have that level and I have those stocks. JPM, there's a pivot and the 100-day come in between 176 and 177. Huge fan, it'll be oversold, get a nice bounce and think it'll hold that level. Celsius, recently breaking down, chart looks ugly. There's a pivot and a chart level and a moving average, 65, 66. MicroStrategy breaking down today. I mentioned it for the past couple of weeks. I've said it's probably going to 1230. We're here. We're breaking down beneath the 50-day. There's probably 100, 200 points more to go. that's less of a swing, but it's going to present a really good, cute, long opportunity at some point. Few other big names that I'm more focused on. NVIDIA, when there's weakness, I go to it. So last night after hours, it traded down after the close. I bought some 856. This morning I got lucky. I sold all of it between 866 and 875. So I'm not reinventing the wheel. I'm going to companies that are showing great earnings growth, that have some sort of moat that we can count on. AMD is now come in enough where 160 looked interesting to me, saw a big upgrade last night, but HSBC, I went long. But I'm also in trading mode where I'm not looking to make, it was a couple weeks ago, we bought NVIDIA at 850 and it went to 950 in like 3 days. I believe we're not in that market. So I have zero problem making 10 or 20 points in NVIDIA, or today I got flat AMD in 164 level because I was like, you know what, on a day like today, that's a home run. So in terms of long-term swings, you have some of the levels. IWM, closer we get to the 200-day, I will go long, swing again there. It's had such great underperformance. I'm very comfortable owning it between 190, 192. XPI breaking down because small caps are breaking down because interest rates are staying higher. I'm not looking at the chart, but I remember most of this. That becomes kind of special at 82, 83, where the 200-day is. Those are all swing ideas. I start to get excited again. Citigroup, 55, 56. So there we go. There's a group of high quality stocks that are levels I like.
Okay. All right. I think that is a good note to end on. So guys, if you want to apply to work with David, if you have a $100,000 plus account, if you have like 2 years of experience and you want to be part of a community of serious high-end traders, go to t3live.com/DP. The link is in the tweet if you're watching on Twitter. It's also in the description on LinkedIn, Facebook, or YouTube. David, thank you for your time. And guys, we'll be back next week, next Tuesday, 12 p.m. Eastern time.
Thanks for doing it again, Michael. Have a great day, everyone.
Thank you, David.